Well, good afternoon and good morning to everybody here today. It's just take a few moments. I know we've just got a few people still coming into the Zoom call, so we'll just take a moment there. But we welcome everybody from wherever you are throughout Australia and New Zealand. We're thrilled to be able to host this session and provide hopefully a great deal of information for you to help understand what's happening in the commercial world throughout Australia and New Zealand. Well, by way of introduction, my name is Andrew Freeman, head of agency for Ray White Commercial. And for those of you who don't know, Ray White Commercial, we're made up of some 48 offices throughout Australia and New Zealand, and of course also having office in Hong Kong. Our specialists throughout the group are all specialising right across all asset classes, from industrial, retail, and build to rent and build to lease as well space. So we've got a great extensive commercial network. Behind us as well, we have some 1,000 total offices in the Ray White Group, and again, a representation right throughout Australasia. Now, today we'd like to obviously talk about those opportunities and challenges that have been throughout COVID. I know we've got very different markets throughout Australia and New Zealand, with lockdowns occurring, and of course also with and some markets open and booming. But it's also about looking down at those different asset classes and how each are performing as we sort of do a bit of an overview around Australia and New Zealand. I think it's pretty safe to say that what's surprised a lot of people in the commentary in the last 12 months. I remember standing here some 18 months ago or thereabouts and looking at what was ahead, and we're in this sort of shock and awe of how the countries are going to deal with this global pandemic, and we're all sort of hitting to those battle stations. But it's I think the last 12 months certainly has shown us that we have got some great resilience in our marketplaces, and how each sector has adapted and changed. I think we're seeing sort of certainly snapbacks in a lot of markets. I know, we look at some of those markets that are not in lockdown or have come out of lockdowns, and how they're recovering and how the consumers are responding to those changes. We're certainly seeing that in that Perth market, where the office market is now starting to really rise and gain some traction, which was a big question across many minds around how the office market was going to deal in those CBDs. But of course, we still see the retail, and especially those retail markets that are continuing to trade through COVID are really doing really well. And of course, one of the most sought after asset classes, of course, is in industrial markets as well. Now, we do have a fairly broad range of participants here today. So if you do have any questions, please do so. Put your questions in. Down the bottom, you'll see a box that's marked chat. If you use that chat box for your questions, we will get a time to address any questions that you have. If they're for George and Nerida, then they will be able to address those. If you have broader questions, maybe perhaps pertaining to property management and rent relief and so forth, we pop that in there as well. We do have our panel of specialists throughout the group online as well to answer those questions live. So we do ask that you do type in your region when it comes to that question, because we do have obviously different laws in place across the states and territories and New Zealand as well. So today we'll be hearing from Nerida Conisbee, our chief economist for Ray White. Nerida has been a commentator. She's actually currently the most quoted property commentator in Australia. She's sought after public speaker and of course writer and columnist, regularly seen on Channel 7 Sunrise and ABC News Breakfast. 20 years in property research, so throughout, and 20 years in research throughout Asia Pacific. So Nerida will take us through a bit of an overview right across the markets as what she's seeing in the trends that are forming throughout Australia and New Zealand. And of course, then we have George Ajaka coming on, managing partner from White & Partners. Now, George, 15 years experience in sourcing, managing real estate investments. Now, George extensive real estate experience or experience in property development, finance, deal structuring across retail, residential, hotels, pubs, and industrial sectors will give us a great insight. Of course, White and Partners, we'll hear a little bit more about White and Partners, but it's that's our family, Ray White family office business that undertakes investments on within the property sector for private investors as well. And of course, the business proudly currently managing in excess of $1.1 billion worth of funds invested. So, two great experts to hear from today. So with that said, I'll pass it straight across to Nerida, which I'm sure everyone's eager to hear Nerida's understanding of the markets and overview. So welcome, Nerida.
Great, thanks Andrew. Thanks for that introduction. So today I'm going to take you through a bit of an outlook in terms of what's been, or a bit of an overview in terms of what's been happening to commercial property, primarily here, but I'm also covering off New Zealand as well. If you want more of a deep dive into any property market, I encourage you to head over to our website. So our head of commercial research, Vanessa Nerida, does do very in-depth reports on commercial property. And also if you head over to the raywhite.com website, we've also got lots and lots of reports being released and commentary being released about residential property. So certainly no lack of things to read. But today really just taking you for a very quick run through in terms of what's happening across Australia and New Zealand. So I'm just going to quickly share my screen and bring up a presentation. So we are now 18 months into the pandemic, and it has been obviously a roller coaster ride. We did hit the pandemic. There was a lot of panic about what was going to happen to the economy. Things got very hot very quickly in terms of a return to growth, and a lot of it had to do with the fact that we weren't at any time through this pandemic in a financial crisis. And then we hit June this year and Sydney went into lockdown, and things are again looking quite different. So today I'm just going to talk through, what we're seeing leading up to June, what we're seeing over the last 2 months, July and August, and then provide a bit more detail as to what we're hopefully going to be seeing going forward from that point on. So in terms of how things were going up until June, it was very much full steam ahead. We had hit record growth rates. Unemployment hit 4.6% in Australia. It got down to 4% in New Zealand. We did start to see inflation edging up outside RBA targets. There was a lot of concern about inflation, and in the end, or not in the end, at this stage though, it is increasingly looking like it is less of a concern, which is likely going to lead to a continued hold on interest rates. In terms of September, what we do expect to see is a slowdown in economic growth, not just here, but also New Zealand, given that they are locked down. It will depend on how long the lockdowns occur, but at this stage, certainly for Australia, we do expect to see a rise in unemployment. We're starting to see it follow through in ABS data. We do expect to see a slowdown in inflation. Retail spending is already dropping, and also the household savings rate is creeping up again as people lack opportunities to buy stuff. There are lots of concerns around the outlook for the economy, the big one being around government debt in Australia, set to hit $1 trillion by 2025. We haven't really had much discussion about how that's going to be paid back. New Zealand has a similar problem, although not really as extreme as what we're seeing in Australia. As a percentage of GDP, their debt levels do remain far more manageable. In terms of opening up, obviously a lot of discussion at the moment around states, particularly when borders will open. Borders are locked down between pretty much everywhere at the moment. New Zealand is still aiming for 0 COVID cases. So what does that mean going forward, given that the rest of the world is opening up? Australia is losing people to overseas. We can see through migration data that although we have been a place that people want to be in during the pandemic, primarily because we have kept COVID cases low and we have been able to live more normally, at some point already, we can see that people are heading back overseas because life is a lot less restrictive at present. Vaccinations ramping up, and then lockdowns, they're a real problem for the economy, obviously, again, keeping us safe in terms of infection rates, or safer. but some big problems around consumer confidence and also business confidence. In terms of interest rates, again, what we did see is this record low occurring pretty much everywhere around the world. We never hit negative like we saw in some parts of the world, but we did see enormous levels of quantitative easing. So not only have interest rates been very, very cheap or very, very low, there has been so much money released, and as a result, banks have been far more easy in their lending than they were, particularly prior to the pandemic when they were going through a royal commission. So lots and lots of money in New Zealand. We have started to see restrictions to finance. The Reserve Bank of New Zealand were set to call an interest rate rise, but it was the day that the first COVID case was announced, so they did hold back. But we are expecting to see regulators step in at some point, given how strong house prices are moving and how much debt, well, not so much house prices are moving, but more because of very, very high debt levels at the moment. I'll show you some charts a little bit later in terms of what's been happening to housing finance debt, which has hit record levels. In terms of commercial property, although we are expecting to see, or we are starting to see 10-year bond rates creep up, commercial property still looks very, very well placed. So this is a chart just looking historically, comparing the prime office yield or income return for Sydney, and also comparing the 10-year bond rate. And you can really see there that, there are times in which that gap between those two metrics, so basically the gap between the risk-free rate and a property yield, does go negative, which is always, surprising when you look historically, but really is on the back of the fact that people do think capital growth will continue. If you see there that from the GFC, we have remained in a fairly, not cheap, I mean, I have put there cheap, but, in a situation where commercial property is relatively well placed. And at this point, even if we do start to see an increase in the 10-year bond rate, as we are, it's still looking, and also on the other side, we do see a firming of yields. It is still looking pretty good in terms of investing in commercial property. Fortress Australia, I did say Fortress World, but really I should say Fortress Australia and New Zealand. It has kept us safe, as I mentioned earlier, but it is starting to become a little bit problematic in terms of how we will be, not just for our economic growth, but in terms of our ability to travel and also our ability to accept migrants. So it did keep us safe. It did trap retail and tourism spending. I mean, one of the interesting things about Australians or about us is that we travel overseas and we spend more money than foreign tourists spend in Australia. So trapping all that tourism spending was very, very good news. We also saw some really interesting views from offshore about Australian commercial property. It was seen as a safe haven, and many of the surveys that were conducted towards the end of 2020 did say the same things. Australia was on top of the list, and it was a preferred option for pretty much all, well, not all, I mean, in some cases all, when the survey was conducted, one of the surveys was conducted in the US, it did show that all investors said that Australia was their top option. So it has made, or it did make Australia a very, very attractive place to invest money. Now that the rest of the world is opening up, that'll change. I mean, one of the problems is of course that we are losing people. That we do have that negative net migration overseas. There are a lot of challenges in obtaining workers in some sectors. So I've been doing quite a lot of work around the agriculture sector, and what is interesting there is that in this summer, the fruit and vegetable sector will need 25,000 extra workers to harvest all that fruit and veg, and it's going to be very, very difficult for them to find that staff. Foreign students can't return, big problems obviously for the educational sector. Particularly problematic for many suburbs that are located close to universities. So I don't think I included it today, but looking at places like Melbourne CBD, Carlton, Macquarie Park, those areas have seen big drops in residential rents because they haven't been able to get students back in again. Regional areas have done incredibly well. So since the start of the pandemic, we've never seen so many people move to regional Australia. And this isn't just something that's happening in Australia in right now this month. It will be released next week. But I have a look at what's been happening globally with this COVID house price boom, and it's pretty consistent. We have seen very big sharp jumps in house prices pretty much everywhere around the world. We have seen this shift to regional areas, and we've also seen this shift to outer suburban areas as well. So, there's a lot of consistency with what's been happening around the world in terms of residential markets. In Australia, there's been three main drivers. Lifestyle's been the big one. Obviously, places like Byron Bay, Sunrise Beach, Queenscliff, we've seen these incredible jumps in pricing. Byron Bay has actually doubled in pricing over the pandemic. It has been one of the strongest performers. If we have a look at mining towns, Port Hedland, Dysart, Newman have seen big jumps, and pretty much any mining sector has done well. So, it hasn't just been all about iron ore. You can see Dysart there with coal, but also gold. If you have a look at Western New South Wales, there's been some pretty big increases as a result of gold mining there. And then agriculture, these towns are obviously very low cost, but they have seen big increases primarily because we had a breaking of the drought. We also had some very strong conditions in agriculture. I did try and find some similar data for New Zealand. Unfortunately, they don't seem to have released anything on internal migration, but certainly some of the discussion there is around people moving out of Auckland, primarily because of how expensive it is, similar to here in Sydney, and moving to cheaper parts of the country. In terms of Queensland, I mean, this is another part of the country that was a huge beneficiary from the pandemic. If you have a look here, what has happened in the 12 months to March 2021, not only did we see this record movement of people to regional Australia, we also saw this really big shift to Queensland. A lot of those people coming out of New South Wales and Victoria, that New South Wales figure is pretty standard. One of the things with New South Wales, it is the state that does attract the most overseas migrants, but loses the most people to other states. What was more interesting was Victoria, which hasn't seen this level of movement up to Queensland since the early 90s. And a lot of that movement took place in lockdown. So, it was a tricky time for many people to move, but nevertheless, they did make a move. So this increase in population in Queensland has led to a lot more confidence in the state. It's led to a big jump in values for property, and it's also being matched with the Olympics and low COVID infection. So there is a very high level of confidence in the state at the moment. And look, hopefully Queensland can maintain that. And I think, now is such a tricky time because, there's so much discussion about open borders and, how quickly we're going to open up. So, very much a lockdown state may not be such a positive thing if they can't find a transition out to being more open to the rest of Australia and to the rest of the world. Moving on to the office sector, and look, no surprises. I don't need to tell any of you that the office vacancy has risen. It's now at a 25-year high at a vacancy rate of 11.9%. This is actually better than I thought. I certainly thought at the start of the pandemic that, the very start of the pandemic, I thought we'd be back in the office within a couple of months. But, by the time we sort of hit October, November, when it did, it was quite apparent that none of us would be working quite the same way again. Or most of us wouldn't be working quite the same way again. It has surprised me that the vacancy rate hasn't creeped up a lot more. What's also interesting, though, is when we have a look at the 6 months to July 2021, we actually saw positive net absorption in most capital cities, except Melbourne. So Melbourne Melbourne and Melbourne CBD in particular is going through an incredible problematic time period, and it will take a long time for it to bounce back. But at the other end of the the scale, you can see there what's happening in Canberra. And Canberra is, we talk a lot about Queensland and people moving to Queensland and regional areas, but on a much smaller scale, Canberra has been a major beneficiary in terms of the pandemic, but primarily because of all that government employment. So a lot of the metrics in Canberra are looking really strong, and so much so that Canberra is set to become the next $1 million capital city after Sydney, probably in the next 2 or 3 months. So, quite an incredible situation that we're seeing there. In terms of New Zealand, they've also seen a rise in vacancies, no surprises, but Wellington hasn't been hit as badly as Auckland in particular. So again, a lot to do with a high proportion of government tenancies. And if there's anything that has come out of COVID, there's lots of things that have come out of COVID, but it is a big growth in the government sector. In terms of what's happening with investor demand, look, investors don't really seem to care that much, and so much so that there does just seem to be a view amongst people buying office buildings that at some point we will come out of lockdown, which is true, and also that employment growth will eventually make up for the shortfall in number of people not returning to work, and that is also true. We are seeing growth in employment. Up until June we were seeing a decline in the unemployment rate, and people will need offices, and really what it does mean is that over a prolonged period we will have a pretty high vacancy rate, but eventually that vacancy rate will decline. No bad news in industrial. I'm sure there is someone who will be able to think of some bad news, but I can't really think of any off the top of my head. It is very much the property type of the century. I think over my career, certainly how people view industrial has changed so dramatically that, when I started, in the 90s, it was really seen as primarily a private sector investment. It was people bought industrial property because it was high yielding. It was certainly very different to the way that people viewed shopping centres, which were seen as fortress-style assets. So industrial is the property type of the century. It is one where it is difficult to find any investor survey that says that it's not the most preferred commercial property type at this point. Total returns do continue to push up, primarily because of capital growth, which is really taken off, and again, when you look at the outlook, there's just so many positives to talk about for industrial, and most of it relates to online retailing, but you can look across a whole lot of things, whether you look at future of farming, whether you look at the future of driverless cars. There's so many future requirements for warehousing, and also that last mile, which will continue to drive the popularity of this sector. Retail is the one that has been quite challenged for quite some time. Total returns did pick up in the June quarter. This is data from MSCI, so I thought that was quite interesting. Whether it will maintain that pickup does remain to be seen. In terms of what we are seeing, though, is that even though you've got this headline figure of quite low levels or even negative capital growth, or negative capital declines in capital, we are seeing some types of retail outperform others, and again, COVID has tipped so many things on their head. I wouldn't have ever said that large format was a retail type of the future, but at the moment, it's certainly performing particularly well. And we've also seen neighbourhood centres do really well. So there's kind of that local area, kind of home-focused retail that's doing incredibly well. But we're also seeing luxury do really well. So that again, is surprising. We're in the middle of the pandemic and people aren't really going out that much, but they're still spending a lot on beautiful handbags and cool sneakers. So this is, and that flows through to property. We can see in commercial strips or retail strips where luxury is around, is that those areas do seem to be doing okay at the moment. The other challenge will be around CBD workers, and we certainly are seeing it in Melbourne CBD at the moment with very, very high vacancies, some really big challenges for people in the hospitality sector in the Melbourne CBD. So Sydney obviously was doing quite well up until the end of June, wasn't really experiencing the same problems. But I haven't been into the Sydney CBD for a long time, but I'd imagine that things are looking pretty challenged for a lot of people that are occupying retail storefronts in that area. Moving on to residential, and I'll talk about this primarily as it relates to development sites. Look, no surprises here. You know, you're all pretty familiar with the fact that house prices have just rocketed up. If you have a look there in Sydney, the median is now sitting at 1.275. It is, in terms of median house price growth, obviously, you know, there's obviously different measures to measure growth, but median house price growth in Sydney has jumped by 36%. You can also see that Canberra increasing by 30%. Melbourne has lagged. You know, one of the things happened in Melbourne was that it did see price declines during its extended lockdown last year. It did bounce back, but it has got a little bit of catch up that still needs to take place. But pretty much everywhere around Australia, everywhere around the world, there has been a ton of money being poured into residential houses, very high levels of debt being taken up, and as a result, prices have really shot up. In terms of who's been borrowing, we have hit, we did double the amount of money that was lent to people in during the pandemic. It has reached $32.6 billion, and it's more than 10 billion more than the previous peak that we saw in March 2017. So, you know, there's no doubt that people have been not only using their high levels of savings to buy homes, but they have also borrowed a lot. Investors took a little while to return. You can see there that they're not quite back to what we saw, you know, in that investor boom of 2015 to about 2017, 18. But you know, getting up there, and first home buyers are starting to withdraw, which is consistent, you know, with a lot around what's happening with a lot of the stimulus that's available to them. In terms of what's been happening with the new development sector, you can see there the tapering off of home builder for the houses for approvals, and you know, pretty rapid decline. But it's still pretty high. You know, I think that's what's surprising. It's still at fairly high levels. Nationally, the unit market has seen a fall, which isn't quite showing up at more local levels. So, you know, in places like Sydney and Melbourne, we're not really seeing that same decline, but nationally the units have pulled back a bit. When we talk to developers and we talk to people within our business who do sell new products, what we are hearing is that it is higher end apartments off the plan that are selling better at the moment, and things that are apartments that were developed primarily for investors is the type of stock that isn't really moving. So it is a very different investment boom that we're seeing at the moment. It's more regional, it's more spread out from Melbourne and Sydney, and when we look at apartments, it is higher quality than what we've seen previously. In terms of residential, it's been quite interesting to look at what happened to to New Zealand's house prices. Once we started to see a restriction on finance. So the first restrictions came in March. The loan to value ratios were pulled back, and that led to a pretty sudden flattening of pricing. There has been another set of announcements which are due to come in October. And then, of course, we did see the Reserve Bank talk about raising interest rates in New Zealand, but did put a hold on it as a result of the return of COVID to that country. So New Zealand obviously is one to watch very closely, given that they have started to put in these restrictions. I think given that Australians are still borrowing a lot of money, and at this point there's no real interest rate rise on the horizon, we will start to see regulators move at some point. I'd say they're probably waiting for a lot of these problems with COVID to reduce before making a move. In terms of alternatives, look, this is another interesting part of the market that some of them are doing incredibly well, and some are attracting a lot of interest. I think one of the interesting moves that we will see is a move by major institutions, more so in alternative real estate sectors. We are seeing a lot of them talk about moving into build to rent. Life sciences has become a really hot kind of sector in terms of discussion. It is quite a tiny sector, but obviously a lot of interest from people. Childcare is another one. And pretty much most alternatives, I think, would be attracting a lot of interest at the moment, except for aged care, which does continue to go through a number of challenges in terms of a Royal Commission, and also obviously what has happened over the pandemic. So that's a chart that was put together by Goldman Sachs, looking at how much US listed companies invest in alternatives. You can see there it's enormous as a proportion of the total amount invested, particularly when we compare it to what's happening in Australia. A lot of that big chunk of alternatives in the US would be build to rent or multifamily, because that is such a huge part of that listed property sector in the US. And finally, rural and agribusiness. I'm sorry, I haven't got a chart here on New Zealand. I did try and find some data, but I ran out of time. But for Australia, it has been such a strong performer. So, we do talk a lot about mining and what that's done to the Australian economy. Obviously, agriculture is not quite as dominant in terms of the amount of money it brings in, but it has been a very, very strong sector, particularly in beef and wheat. So they're the two that have done well, primarily off the back of poorer conditions elsewhere. So apparently all of the US wheat crop has now burnt up and has been converted to hay. So terrible, obviously, for the US, but good news for us, because it does mean that our wheat, which is high quality, has been seeing very, very high levels of exports. It's flowing through to farmland prices. They are up, according to Rural Bank, up 12.9% over the past 12 months. It is their 7th year of consecutive growth. A lot of people investing in rural businesses, in farming businesses, are looking through adverse weather conditions. Obviously, we've had great weather conditions in Australia, but that a lot of investors are looking beyond that. We're also seeing very high levels of investment coming out of large institutions in places like Canada and the UK, and also through Europe. So on one hand, we do see fewer, we have seen this high level of interest, but also fewer transactions taking place. So high consolidation of parcels and longer holding times. So I'm going to finish off there, and I'm going to pass over to George, and I think we'll open up at the end to questions. So thanks for having me.
Thanks, Nerida. Thanks, Andrew. I'll just share my screen. Get started. All right. Good afternoon, everyone, and thanks for the opportunity to present to you today. So I just thought I'd take today's opportunity to discuss really what our business, White & Partners, is seeing, experiencing at the individual project level. So taking a more micro aspect and view of what is happening in our portfolio. And you've all heard Nerida's great presentation around the macro themes. And to be honest, it's largely consistent with what we are experiencing and feeling on the ground. And so today, not only will I discuss a bit about what is performing across our portfolio, but also what is keeping us up at night, i.e. what is concerning about the future, as well as where we see some potential opportunities that lay ahead in the next 12 to 24 months. So starting off, snapshot of our portfolio today. So at White & Partners, as Andrew kindly introduced, White & Partners is the Ray White family office. So family-led, principal investment-led investment company. We invest along the capital spectrum and across any sector within the property market. We do not have specific mandates or restraints. We're quite open-minded into where and what we invest in. A key part of our decision making is who is our partner in the deal. So whether it's our borrowers or our JV partners, every project that we undertake has a partner. So the partner, in our view, is as important as the underlying property opportunity. So today we have approximately 1.138 billion invested of funds actually invested in various projects. On the bottom right-hand side, you'll see a pie chart which shows that approximately just over half of the funds invested are allocated into senior debt projects, middle stretch senior debt. Just under 1/5 of our portfolios in junior debt. So that is mezzanine finance and preference equity or some form of structured equity. And just under 1/3 of our portfolio is in projects that we own or operate with a partner. On the left-hand side, you'll see the sector breakdown. You can see there that just under 90% of our portfolio today is invested in industrial and residential land subdivisions. And look, fortunately for us, they are two sectors that, as you've heard from Nerida, that are performing incredibly well since COVID kicked in. They were performing, well pre-COVID, but they have since been supercharged or turbocharged since COVID, the effects of COVID and government policy have kicked in throughout last year and this year. The balance of our portfolio, we have some luxury residential exposure, some hospitality, as well as some mixed-use projects and in-one-line apartments. Admittedly, ladies and gentlemen, some 2 to 3 years ago, this sector chart looked materially different. We had a much larger overweight exposure to the hospitality sector, to pubs, as well as mixed-use projects throughout Brisbane and Sydney and Melbourne. We've since sold out of many of those holdings off the back of strong runs in those particular sectors and replace those funds in the industrial and residential land subdivision sectors. At White & Partners, I should just note, we are an active manager. So we're not a passive manager. So what I mean by that is we do not invest in core property. So we will not acquire an industrial shed that's got pre-commitments, or it's a standing shed that's got a 10-year lease that is being acquired on 4 to 5%. We're much more engaged in acquiring, for example, greenfield sites, finding those tenants and developing that project over time. It also means that we typically do not hold on to assets for the long term. Once the assets are maximised, in our view and their use, we will, subject to market conditions, seek an exit in order to reposition those funds elsewhere. And you can see there on the top part of the slide is some of the returns that we've achieved over the last few years across our different projects. So moving on to a bit about the commercial real estate lending environment in Australia right now. It wasn't that long ago that the word non-bank lender really didn't exist or wasn't a familiar term. You can see in the top left-hand corner of that line chart that in the grey, somewhat grey or beige line there, that the commercial market, the commercial lending market in Australia has changed quite materially in the last few years. And a lot of that came off the back of the Royal Commission and banks being forced to pare back exposures to a number of different markets, from construction to certain capital cities and regional areas, as well as land banks, etc. So it allowed the non-banking market to evolve and eventuate. It's been around for a long time, but it hasn't been around on an institutional level, which today it is. And it's evolved very quickly, You can see it obviously in 2020, that market has come back in 2020 off the back of obviously COVID, the lockdown, and a number of players there just being quite concerned and deciding to hold back, increasing their exposures. But still very healthy growth where in the non-bank lending market. When you compare that to the right-hand chart, which is effectively all Australian banks. And the key line to take note of there, ladies and gentlemen, is the line chart, which shows that pretty much since the GFC, and more so since the end of the Royal Commission, the banking exposure to commercial real estate lending in Australia has been declining for, the rate of growth has been declining year on year on year. And that is a trend which, look, should stabilise at the moment, but it's allowed the left-hand chart eventually to come alive. That said, the banks have been increasing their exposure to corporates, which again is a lot of the back of APRA and ASIC's push to fundamentally create employment jobs around small businesses and medium-sized businesses. Just a bit of education, so to speak, around who are some of the players in the non-banking market. On the left-hand side is the more institutional players. PGIM, MetLife, Manulife, Nuveen. Look, the constant theme around these players, ladies and gentlemen, is that the majority of our institutional capital market in Australia is largely led by offshore pension funds, whether from Europe, Japan, Singapore, and obviously the United States. The reason that has been the case is the non-banking lending market in Europe and America has existed for the last 15 to 20 years in substance, whereas in Australia, it's only a recent thing, so to speak. These players, they effectively compete against our banks. They provide longer term debt. They only lend to Tier 1 lenders, so they're very picky, but their pricing is very competitive. They're not that much more expensive than the Australian banks. On the right-hand side is your more property private players who have evolved into quite a meaningful business from the likes of Metrics, Wingate, Alcyon, Qualitas, etc. These guys, compared to institutional, will play higher up the risk curve and obviously charge, rather than your 3-4%, they're charging your 8 to 10%, so to speak, or more so today, probably 7 to 8% as competition increases. We have also noticed the number of smaller private offices lending from the suburbs of Toorak and Double Bay, etc., in Sydney and Melbourne on the rise as well, as family offices decide to create their own lending books off the back of the increase in non-bank lending in Australia. At White & Partners, we typically like to differentiate ourselves by playing up the risk curve, so to speak, compared to many of our peers, and lending at LVRs, for example, or opportunities that our peers won't. And our principle there is, if we have strong enough belief in the property and our partner's capability, our capital restraints should not be a deciding factor around how we decide to invest in a project. So if the property is appealing enough and our partner is smart enough, intelligent enough, and has a relevant experience, we're willing to back them. Obviously, we charge a little bit more for it, but we create opportunities that our peers don't particularly play in. Just moving on now to where we see what our strongest performing sectors are in the current environment. So today, obviously, residential land is performing, and it's also performing across the price spectrum. First home buyers to second, third, and upgraders as well. On the left-hand side, there are two projects here I just want to highlight. On the left-hand side is a project in the southwest corridor of Sydney, which has predominantly been driven by first home buyers. On the right-hand side, it's the northwest of Sydney, Marsden Park, which this project, much larger lots, 600-700 square metres, up to 1,000, and the price point is much more expensive than the project on the left-hand side. And you can see that what happened more specifically in Cobbitty is during the lockdown periods, the price, the line chart there, held up quite well. Volumes, albeit took a hit from the first quarter of 2019, as first quarter of 2020. However, volumes did trickle along up until pretty much the last quarter of 2020, where the market really did come to life off the back of the opening of borders, federal government grants, and state government grants. And had the project in this instance had more supply of land lots, you would have seen November and December really been much stronger than the 41 lots sold there. What I do want to highlight is a project that the same developer released in April of this year, 300 lots, and in 1 month, in the month of April there, known as the Muse, that project recorded 74 sales at a price that was 50% above what was being achieved just 3 to 4 months ago. That project, the Muse, compared to the grey chart project, compared to the blue chart project, to give you an idea, was less than 1 kilometre down the road in Cobbitty. So you can see the supercharged returns that developers are experiencing in this sector. On the right-hand side is the project which was not stimulated via government incentives. And that project they launched in June 2020. And you can see for the first 6 months of the campaign, they did not actually achieve many results at all. However, in the first quarter of 2021, the developer there quickly sold out of their project virtually immediately, to the point where they admitted that they pretty much undersold that project. They had the potential there to increase the prices of those lots. However, due to the speed of the demand intake, weren't able to quickly react enough in time. And this is quite a common theme, ladies and gentlemen, where you see the government incentives target the first home buyer and eventually have effects through the market to the second, third, and fourth home buyer, so to speak. Moving forward with residential land, we are somewhat a little bit concerned in the sense that much of the demand has been brought forward from the intended demand that was there in 2022, 23, 24 has now been rushed forward to 21 and 20. So whether or not the demand is underpinned in the medium term for land across the country will be an interesting stat to watch. Further to Nerida's comment around industrial. Look, industrial, again, has been performing for the last decade. There's no secret around that. But again, I just want to highlight 2 projects that we have an involvement in. The left-hand side is a project, a greenfield project near Sydney's new airport. The right-hand side is a brownfield project. So it's an infield project, effectively. You can see that industrial land, despite having a record run for the last 10 years, in the last 8 months for greenfield land in Sydney, we have experienced nearly a 100% increase in land valuations there. What's interesting around this one is the dark blue line is the valuation that was undertaken by CBRE and Colliers. The light blue line represents the latest EOI expressions of interest that was undertaken by relevant agents on offers received, just closing pretty much 2 weeks ago. And you can see the supercharged increase in land valuations there. The same can be said for brownfields. A project that settled in January 21 for 13 million today, 8-9 months down the track, is now valued at just over $20 million. Very different demand drivers as well, ladies and gentlemen. So on the left-hand side, you have demand drivers from your larger national operators, from your Amazons to DHLs, etc. And on your right-hand side, it's your local suburban business, your local butcher looking for cold storage, your local tradesman, your local self-storage business, so to speak. So across the platform, we're experiencing very strong demand from industrial users, which again is just turbocharging returns. The same can be said also for luxury residential, further to Nerida's comments. Again, I just want to highlight the strong returns experienced for developers in tier 1 locations. So here are 4 projects that we have visibility to. And you can see that pretty much from when the agents pitch the business, pitch for the business in the last 12 to 18 months, to what they have achieved in the last pretty much 3 months of sales rates, we have experienced somewhere between 15 to 30% increases in prices of these luxury apartments across Sydney and Brisbane. So again, highlighting the continued theme of supercharged returns in these in certain sectors of the property market. The same cannot be said for apartment projects in inferior locations, whereby lockdowns, smaller apartment sizes, issues with defects and building commissioners are essentially the perfect storm for many projects in inferior locations, whereby the apartment values, unfortunately, are actually going backwards or stagnant. So moving on a bit to what we are concerned about, what is keeping us up at night as investment managers. And it is a continued theme of inflation, whereby, look, it's not a short-term concern, but it is certainly a medium to long-term concern. There are 4 charts here, of which the top 2 charts you can see, ladies and gentlemen, are around the construction prices that are being experienced across the country, both in wages, i.e. tradesmen, and also input prices. So the price of steel, the price of timber, etc. And I'm sure many of you have seen similar charts before. And the concern that we have around such charts is, with the construction boom happening around the country, is it makes it very difficult for starters to actually consider any form of development project today. Whether you're looking from Perth to Sydney to Brisbane, Melbourne, with the way construction prices are increasing, you cannot adopt today's construction price, knowing with the growth chart that is experienced, and potentially in the next 6 to 12 months, that there's a potential another 20, 30, 40% increase in construction prices, which fundamentally impacts your valuation. It also means that for developers who have acquired sites in the last 18 months in inferior locations are potentially going to experience financial difficulties with achieving feasibilities that actually stack up, especially if they're not experiencing these kind of returns. For developers in Tier 1 locations, they're able to absorb these increases in construction prices. Unfortunately, for those who are not, these kind of charts are worrying, because it will only mean a backwards reversion for their potential site values. It also puts inflationary pressures, which again, while short-term isn't an issue, medium-term is, with compounded with the 2 charts down below. The left-hand chart shows the increase, the spike in the private sector wage growth. Now, while it's still low compared to historic standards, if this trend continues, and it will continue in our view, if the right-hand chart over here, the population growth with the migration, the net migration, if net migration continues to be negative and our population continues to go backwards, we will have significant pressure on wage growth in Australia, which means, in our view, in the property sector, it will continue to put inflationary pressures. It will continue to increase construction prices, and with potential increases in interest rates, it will mean for going concern assets such as retail, office, hotel, pubs, etc., industrial, that there is the potential for our historically low cap rates to start reverting upwards. And this may be compounded by the fact that our outgoings on office, for example, and on retail, which you've got to remember, ladies and gentlemen, Australia for the last 20 years has been the beneficiary of very strong migration levels. And many of those migration levels have filtered through to the property sector through construction, but also through simple skill sets such as cleaning. And so when we potentially have an issue where we're not taking immigration on, that our outgoings rate for certain sectors of property may actually increase, which means our net incomes will decline. So there is a concern for us in the next 2 to 3 years that if this trend continues with our population, we may have a perfect storm for going concern assets, whereby we have increasing interest rates and declining net incomes off the back of increases in outgoings. To that point, I'll finish up with, where we see opportunity in the next sort of 12 to 24 months. And I think on this point, ladies and gentlemen, we are a little bit hesitant to be brave enough to forecast what is going to happen over the long term or the medium term. So we have taken a view in-house that moving forward, our opportunities are more going to be focused on structured positions. And what I mean by that is that we're not really interested in first loss positions. We are also not really interested in longer term investments between 3, 4, 5 years. We are more focused on shorter term deals whereby we can see an exit within the next 12 to 24 months. We feel that the Australian economy is well placed to handle the potential shocks for the next, for the next 24 months. Beyond that, we do not know how people's behavioural patterns will react once we're out of lockdown. And that includes not only in Australia, but also international pressures such as China. We do see industrial opportunities in Brisbane, especially as Sydney becomes quite expensive. And so, we do see a trend whereby larger corporates are deciding where they'll decide to place their headquarters in Brisbane over Sydney or Melbourne for that matter, off the back of the fact that industrial properties has not had the same surge that what Sydney and Melbourne has. And as a result, as a business, it's much cheaper for them to be in Brisbane, along with strong infrastructure spend that is only improving connectivity between the capital cities on the East Coast. Regional areas, as you heard from Nerida, are having experienced very strong values and growth. Again, from our perspective, we do have exposure to some regional. Again, it is all short term. We don't know if the regional trend is a permanent thing or a more short term pattern in behaviour. And as such, we are focusing on smaller land subdivisions, smaller boutique projects where we can see an exit in 12 to 24 months. It is our view that the childcare sector is set to have another bounce back in values, especially as our migration's gone backwards, our population's gone backwards. I think the reality is the government knows, just like Peter Costello did back 10, 15 years ago, the famous words of have one for mum, one for dad, and one for the country will most likely have to eventuate regardless if we have a Liberal or Labor government moving forward. And I think there will have to be a baby boom in order to stimulate strong population growth in Australia. Just ending off again with some alternatives. I'm sure everyone would have noticed when you head down to the local park that you probably see more pets than you do children at the moment. And I think as lockdowns have eventuated, we've replaced our children with pets, probably because they're easier to manage. And I think off the back of that, the pet sector, especially the pet accommodation sector, will continue to benefit as lockdowns open up. The final trend that we do think is here to stay is the suburban office trend. And we do believe that is a sector that we do see it being here to stay, off the back of, I think, people realising they don't need to work too far from home. Whether or not the CBDs come back, I think time will tell. And I think time will heal that fact, that the office CBD. But I think the suburban office trend is a trend that, in our view, is here to stay. And on the back of that, ladies and gentlemen, I will hand back over to Andrew, and thank you very much for your time.
Terrific. Thanks, George, and thanks, Nerida. I think, George, I think you had that in the last 2 minutes there. You had, I'm not sure if it's a forecast or a hope for childcare to surge in due course. Everybody, thank you very much for your time. I've literally only got 1 minute left, and I know we have an abundance of wonderful questions there. I know a number of those questions have been addressed as the presentations went forward, but we will keep them. I know that your questions are important to you. They're very important to us. We will address them directly with you, especially when it comes to some of that market-based questions around incentives and so forth like that. So we'll connect you with our specialists in those various markets to answer those questions. We are seeing, as you've heard today, there is strong growth throughout. I mean, as a group, both in our commercial and residential businesses, we're seeing phenomenal results across the auction markets, with more registered bidders and more active bidders and participating in auctions, many of which have been sight unseen, just really showing us that demand and drive for good quality property. So it certainly is a fabulous time to be out on the market. Our next session, which we will communicate out to you as well. So we will have our managing partner Rob Wilson from Ray White Valuations, talking about what is happening with the values of commercial properties across the landscape, as well as our Managing Director of Ray White Group, Dan White, also presenting to you. So we'll connect with you on those dates when they're finally set in the coming weeks. But we look forward to seeing you online again for our next session again on property values and the state of the market as well. But thank you for your time. Thank you for taking the time out of your day, and we look forward to seeing you on our next call. Thank you.